Hey everyone, good morning. So we are live on YouTube. We are live on Zoom. And I already have a million questions by Nina. If anybody else has questions, please drop them now in the chat. Take advantage. All right. I don't know what, before I go into the questions, as I'm waiting for you guys to drop a few more. I don't know if I mentioned yesterday, I think I didn't yet for you guys, but I'm going to show you here real quick. We made an update to the student portal. And in the student portal, right below, as soon as you see student portal, the first thing you're going to see is join our live class. And the information is always going to be updated to the morning or the evening class or whatever classes we might have. So the class starting at that moment, you can go right here. Also, I always post that you can go on YouTube and watch live. So click here. Just pay attention. It does not count towards your hours if you do go on YouTube. The other thing I want to point out is I appreciate all of you that are following on YouTube, and I recommend everybody to subscribe if you guys can. If you subscribe to the YouTube channel in the future, besides the quick videos that I will be creating, or that I'm creating, and besides just being up to date with a few things that are important and relevant to real estate, the New Direction School is also a school for insurance, and you're going to start seeing a lot of insurance classes there too, which might help you regarding your personal financial matters. We're also going to start having mortgages. We're getting approved finally to do the mortgages, both pre-licensing and CE credits. So there's a lot of updates coming to New Direction School's YouTube channel. Okay, so definitely subscribe to it. We also going to start. This is a project not for tomorrow, obviously, but pretty soon we're going to start New Direction news. So we're going to be telling you what's happening in the real estate market. So as a professional, once you're licensed, or even as an individual, once you're licensed or not, doesn't really matter. New Direction news is going to tell you what's happening right now in the real estate market, what's happening in the stock market, in terms how does it impact you as an individual versus those channels that just talk about, oh, this stock went up, this stock went down. No, what's happening? How does it impact your life? New programs. We're going to be interviewing mortgage people and talk about new programs regarding mortgages. So FHA, conventionals. What can you do? How can you get into a construction loan? How can you get into more than 5 units? So commercial loan. How can you do all these different things? They're all going to come through New Direction News. Now, it's not something, again, for tomorrow. I'm looking to probably kickstart this by January. So it is coming up, still setting up a few things. And the next 3 months, they go by really fast. So October, November, December, like, it's really fast. Holidays are coming. So I cannot tell you that it will start before then. But I think it's going to be a great resource, again, whether you're licensed or not. So if you ever go to the YouTube channel, or if there's anybody watching right now on YouTube, click the subscribe button so you can get all these good updates. All right. Yesterday I talked about the also with a class. I talked about the Earn with Us. That's your link to refer. So if you ever want to refer business and get compensated for it, I'm just mentioning again, compensate for it. You have here your own unique link, and this link is what entitles you to 20% on all the sales. So if anybody joins through you, this link is unique to you. So if you refer somebody, you get 20% of whatever they paid for the course. And this is all courses for as long as they come to the site. So they by pre-licensing, 2 years later, they do CE credits, boom, you get paid. 3 years later, they do broker, boom, you get paid. They do insurance, you get paid. So no matter what, you can earn money. Again, whether you're a student or not, whether you're licensed or not, this is there for you. Just a few things that we created to help you in your life, and it helps us as well because it helps us grow. Okay. The other thing I ask for, if you guys ever can, and I'm taking advantage now to ask for these things, it's early in the morning, you guys still thinking what the class is going to be like, right? Another thing that I want to talk about real quick is not about me. That cover this face for a second. All right, not about me, but we have here great reviews. We're doing right now 5 stars. Somebody did 4 stars at one point, which is totally fine. But I would like if you guys could to give your review. So you can go to Google, you can go to Facebook. As you can see, you have all of them: Facebook, Google, Yelp, wherever you guys can go if you like what you see so far. Definitely help us keep this 5-star rating, or give us the most honest rating you can get. If you like it, you like it. If there's something we can improve, we appreciate that as well. But make your most honest review. It helps us grow as well. Okay, so that was my quick 5-minute advertisement of the morning, and I will start the class. All right, let's see what we got. So we're always improving, as you guys see. All this technology, putting things into play, getting better and better. All right, so let's address Nina's questions, which is everybody's question, I'm pretty sure, or questions. Just, I'm happy. You know what I'm thinking by now? I'm thinking all of you submit secretly. You're sending a message to Nina and say, Nina, you have the guts to ask questions. Could you please ask this question for me? That's what it is. So Nina, you are the spokesperson, you and Felix, the official spokespersons for this class. That's what it is. So first question of the day. Can you use a mortgage to purchase a short sale property, or do you have to fund yourself? And the answer is yes, you can use a mortgage loan. Mortgage loan, remember, 2 separate things. We're going to talk about better today, but could you use a mortgage loan to finance? Absolutely. A sheriff sale, which is a little different, sheriff sale is an auction, a live auction. Sheriff sale, you need to buy cash. At least at the auction, must be cash. How you got that cash could have been a private loan, right? But it's not a mortgage loan. So short sales, it's a regular transaction. The only thing about a short sale is that there's some type of negotiation with the lender to approve to sell for less. All right, so that's a few things we're going to talk about as well. Next, do sales agents prepare BPOs? Do sales agents prepare BPOs or BOV, so broker price opinion or broker opinion and value? It's the same thing. Or does the broker prepare them? Well, here's the cool thing. It's a broker's price opinion, but yes, you can prepare it. There's actually courses sponsored by the National Association of Realtors, and the REB has something similar as well. But there are courses that allow you to become an expert at BPOs. And the cool thing about a BPO, I'll give you an example. When I was doing them, I would work with bankruptcy attorneys, divorce attorneys, probate attorneys, and they would ask me for the BPOs. So it's not comps, because comps or CMA is for somebody who wants to buy or sell. BPOs I'm providing to lenders so they can evaluate, so they can realize what the value is, the current market value is of the property without going through a formal appraisal. And out of these BPOs, I would get paid anywhere between $75 to $150, sometimes $200, depending on how extensive it had to be. So if you do 3 BPOs a day, external BPOs only, which means You're going by superficial data, like just drive by the property if you want. If not, you have pictures, you have a bunch of data that you can pull. That's $75. If you need an in-depth BPO, then you have to go inside the house, check the conditions of the house. So it has to be scheduled. You go there, almost like an appraisal, like they have to go and see the property. Same for the BPO. And you could charge $150, $200 to get this done. Do 3 of these a day, and it's called $600 a day right there. Right? So, and you do them in like 2 hours. Let's say worst case scenario, 2 hours. So $600, 6 hours. First plus travel time. But anyway, it's a great way to make an additional amount of money. Now, just keep in mind, anything you do bearing a flag, so whoever you represent, must go through your broker. So if you intend to do BPOs, talk to your broker. Because again, you're using their resources and their brand to conduct that evaluation. Do brokerages offer training on how to make a report, on how to do comps? Got it. Yeah. So the answer for this is they're supposed to, right? They're supposed to. I would love to say yes, they do provide it to you. I would love to say that. But unfortunately, some brokerages out there is congratulations on getting licensed. Now get out there and learn on your own. Just do whatever you got to do. They're supposed to be there for guidance, right? Brokers are supposed to be there for guidance, for support, for training. But every brokerage, and I'll tell you this, I'm not trying to, I don't promote any particular brand. You guys, I think by now already know this. Because I don't think it's the brand, it's the branch. You got it? Because there's great Keller Williams offices, and then there's offices where you should stay away from. There's a great Century 21 offices. There's some you should stay away from. Leadership within each agency is different. There might be a pattern, and that's what a franchise is. It's a pattern that all offices should follow, but then leadership changes from office to office. So when somebody asks me, "Oh, should I go to a Keller Williams?" Well, it depends. Which one do you intend to go to? Let's talk about that. That broker. Let me see. Who is it? I just asked that to somebody yesterday. Who's that broker? Let me see if I know. If I can give an opinion about where you're heading to. You know? So it's not the brand itself, it's who's the leader and what they're supposed to do. So yes, they're supposed to train you on this. Which do you think is a better investment for an income property? In-unit, washer and dryer, coin insert, common area, washer and dryer, or none? Huh. Completely random question. Which one I think it depends on the type of property you have. If you have a 2-family, you might not have much room to have the common area for washer and dryer, for instance, or a single family, you're going to have in-unit, obviously. If you have a 100-unit apartment building, you might not have the room for a common area washer and dryer, so or in units. So which one is a better investment depends on the property you actually have. I have a friend of mine is from New York, and he bought 100 units in Ohio. No, I'm sorry, Ohio, Idaho. And he bought 100 units there. And what he did was actually change everything in each unit, right? So they would have so he removed the washer and dryers they had there and put them all like one floor. He killed one floor just to put that common area. So the common area included a laundry area, and then a little recreational area, right? So like a clubhouses type of thing, right? So he created all that in one of the floors. Completely killed it, one floor and income, but gained value to the whole building, right? Because now people don't have it in the house, but then they have other things they can do while the laundry is getting done. So it's still coin laundry, right? So you put coins there, but then while the laundry is there, you can go watch TV, you can go play pool, whatever. It's everything right there. Does that make sense? So it depends on the type of property and how can you arrange. So you have to think about that. there's no direct answer sometimes to certain questions of what gives value to it, right? Like Vanessa yesterday asked about the essentials, like the bathroom, the kitchen, the bedrooms. Is that what gives value? It depends, right? Usually, yes, but it depends. What is in demand in this particular area, for instance? Is this chapter separated into 2 chapters? No. So this right here, chapter 17 is a, first of all, 29 pages, right? So it's very lengthy. The second thing about it is some schools, I don't like to talk about other schools, that's not what I'm doing, but some schools rush right through. But because there's a lot of testing on financing, so mortgages, and in real life, you need to know the basics of this thing, right? Because of that, I prefer to take my time. So I break it into 2 days. And because I break it into 2 days, we have part 1, I'll give you break, part 2. Then we have, in this case, we're going to have the weekend. But then Monday, we'll do part 3 and then part 4. Because it is a lot of information, right? So I prefer to take my sweet time and make sure you guys understand fully the mortgage lending industry, okay? Yep, that's right. I like Nina. That's it. You're a little girl now. Nina. Lol, Vanessa, lol, right? But at least you learn. I mean, I did say post questions before we start. At least she compiles the questions and then dumps all the questions at once. It's great because we address all these things. Felix, you're falling behind though. Come on, man. You used to ask a lot of questions. Now it's like one question of yours is like 10 questions of Nina. What's going on? You got to balance things out. Right? The 2 of you ask the questions for everybody in this class. Come on. All right. So if anybody's watching on YouTube, we're about to start the class. If anybody's watching on YouTube, if you have questions as we go, please let me address your questions. Let's take advantage of this free service that I'm providing through the YouTube Live. Okay? Ready? Thumbs up if you guys ready. Watch people on YouTube put thumbs up too. I can't see them. I know. I'm evil. I know. All right. Cool. So real estate finance, we're going to start talking about the anatomy of mortgage lending. We're going to talk about initiating a mortgage loan, how things start, right? Qualifying a mortgage loan, closing the loan, laws affecting mortgage lending, the mortgage market, and the types of real estate loans. Like I was saying earlier with Nina's question, I'm going to break this down into 4 parts, this chapter. It could be done in 2, but I really want to make sure you guys get everything straight here, okay? So let's start with anatomy of mortgage lending. Under anatomy of mortgage lending, I'm actually going to break a word down first before we proceed in talking about the mechanics of the loan, financial components of a loan, promissory notes, and mortgage documents. I think every year I've been evolving on teaching this particular chapter, but one thing that I never changed was this: explaining what the word mortgage mean. Because if you don't understand the word mortgage, then you don't understand what we're doing here, right? This whole chapter will be a blank because you need to understand who's the mortgagor, who's the mortgagee. You need to understand what mortgage actually means. So all these things that we're going to learn today are very, very important. Arlene, no. So if you are, if you're doing it for these chapters for the first time, so I'm addressing the question, even though you put on WhatsApp instead of Zoom. If you're doing the hours, if you need the hours, like you haven't completed these chapters yet, if you need the hours, then your camera needs to be on and facing you. So I need to see you. because he needs to count your hours. When we go review, either me or my assistant that's been helping me review now some of the videos and attendance, if we need to review and you're not there, that means you're probably not paying attention. So that's why I keep on asking questions and asking for you guys to participate, because I need to show the real estate commission, if I ever get audited, I need to show the real estate commission that you were present, that I did not just give you hours because your session was on. Okay? So very, very important. Keep the camera on, keep it focused on you. Otherwise, it will not count towards your hours. If you have done the course within the past year, if you've done the course within the past year and you're using this as a refresher, you don't need, like Vanessa right now is doing just a refresher. She doesn't have the camera on. You don't need to have the camera on. But again, if it's the first time within the past year, if it's the first time you're doing this, then yep, camera needs to be on all the time. All right, let's go back to this. Mortgage. Don't ask me what this is. I'll explain later. So the word mortgage we're going to divide this into two. Now, who can tell me what this word means? Let me know in the chat. What does this word mean? If you speak any Latin-based language, this should be easy. Or if you understand. Thank you, Nina. Death. Great. I mean, not great, but yeah, that's what it means. What about that word? Gauge. Anybody? So mort means death. What about gauge? Not Google. Think about it. Gauge. What does gauge mean? No? Too early to ask questions? I mean, Nina throws me a bunch of questions and I had to answer, so I'm asking you a question. Right. Joe just passed state exam. While I'm waiting for you guys to... range. Time. Okay. Keep going at it. There's only 2 people are going to give the answer. Come on, guys. Nobody had coffee this morning? All right. Everybody get up. Let's do jumping jacks. No? All right. I'm going to help you. Fine. And Felix, get off WhatsApp. Stay here. Since you're not answering here, don't go and give congratulations over there to anyone. Right? All right. So gauge. Fallon, yeah. People, focus. But no, that's not the answer for gauge. But it's death. Pledge. When you engage in something, you are committing to do something. You're pledging to do something, right? When you're engaging. So the word gauge means pledge. And depending on where you're from, it could actually mean grip. That's weird. So Bruno, you're telling me that if I have a mortgage, I have a death pledge or death grip. And the answer is very simple. The death is not yours. The death is the death of the loan. Okay? So until the loan dies, the bank has a grip on your property. It's called lien. Until the loan dies, the bank has a grip on your property. So if you fail to pay or follow any of the conditions of the mortgage documents, right? What can the bank do? Because they have a grip, they have some type of entitlement, a benefit or interest in your property. They can foreclose, they can enforce the lien, they can enforce that encumbrance, right? So that pledge is because you pledged your property as a collateral for the loan and gave the bank a grip on your property that allows them to recover their money by foreclosing on your property and receiving the proceeds. All right, so that's what we're going to talk about today. Mortgage, we're going to talk about that death pledge that you gave, right? And how the bank has a grip on your property. Now, with every mortgage, if there is a mortgage loan, then there's two documents. With every mortgage, there's two documents. There's a document called mortgage, right? And there's a document called promissory note or bond. Okay? There's a document called mortgage and a document called promissory note or bond. Let's figure out what the mortgage really is. You already know what it means, mortgage, right? Oh, missing something here. Here you go. Okay. So mortgage, right? What is the mortgage? I already told you that the mortgage is a pledge or grip. Pledge or grip, right? So you pledge the property as a collateral or security. You pledge the property as collateral or security for the loan. Therefore, when you see the word mortgage, you have to see the house. Mortgage is not the money. Mortgage is the house. So if the mortgage is a house, the mortgage is the lien against the house. Okay? I'll zoom out and explain this better in a second. But right now, this is what it is. Mortgage equals collateral equals pledge equals house. The promissory note or bond, right? Commitment. Promissory note is an IOU. I owe money to you and I promise to pay. So promissory note is an IOU or promise to pay. That means that the promissory note represents the loan. So that means money. Okay? Two documents. One represents the house. The other one represents the money that was lent to you. All right, so here you go. Mortgage, pledge or grip, collateral or security, house or lien. Promissory note or bond, it's an IOU or promise to pay. It's the loan, it's money. These are the basics. The sooner you understand the difference between these, the easier it will be for you to understand what comes next. So mortgage is the house, represents the house, which we give up or pledge as commitment if we don't pay the money you lend me. You got it? The lender lends you money. I'm going to repeat this again and again and again to make sure you guys got it. Lender lends you money which you promise to pay. But why would the bank lend you $300,000? Because you gave them a security. Now, we don't give the security to their hands. What we give is a piece of paper that represents the security. That piece of paper is mortgage. The mortgage is the security, is the house. The mortgage is the paper that says, if I don't pay the note, take this paper to court so you can get the house. You guys understand? So these are the mechanics. They come with it. There's mortgage documents. Elda, make sure all your notes, or guys, make sure if you send me a message, it's during the class, do it on Zoom, because then the people on WhatsApp are going to be like, what is he talking about? So use the Zoom chat to send me messages. Can I repeat? Which parts did you not get? Let me know. Don't tell me everything. We've been at this for 40... No, just kidding. Guys, make sure the cameras are on you. Brittany, you're always in the dark. Like the contrast, I can never see you. I know you're there. There's a presence. You know? It's weird, like there's a presence. Nowadays, like, you know, somebody was asking me about haunted houses. So, presence. All right, let's see. Waiting on Elda, just give me a second. Arlene, if you can, lower the camera towards you a little bit, just a little bit, and Olga as well. Jacqueline, left. Benjamin's like far, far away, but I can still see you. Nina always got the ninja pose. Mask on. I know it's you. It's okay. Watch, one day she puts somebody else and just, you know, the hood, the mask. I'm here talking to Nina and it's actually John. What's up? Elda says the second part. Elda, I don't know which one is the second part. But is it this or here? This one? Right here? Okay. So what I was explaining here is that there are two documents. Let me put it right here. There are two documents with every mortgage loan. Okay, traditionally two documents. It could be either a deed of trust or a mortgage, which I'll explain better later. But for now, let's stick to mortgage and promissory note. If you borrow money to buy a house, right? Then the bank is going to draft two documents. One is the promissory note, which says you promise to pay the loan that I just lent to you, right? And the other one is the mortgage document that says, hey, if you don't pay, we take your house. We have the right to take your house. So there's two separate documents. So the mortgage itself is the pledge of the property where the bank now obtains the grip or allowed to have an interest, a beneficial interest in your property if you don't pay. The promissory note or bond is the IOU, or I promise that I will pay you the money that I borrowed. So pretty much what I was trying to show you guys is that the mortgage, the word mortgage, means house or lien against the house. Okay, that's the word mortgage. Mortgage is not the loan. Mortgage is the house. Mortgage is the collateral. Okay? The loan is the money and is represented by the promise to pay, promissory notes. And then what I told you was, you borrowed money to buy the house. Not the mouse, the house. This is a house, okay, for today. Not the mouse, house. So you borrow money to buy the house, right? They drafted a piece of paper that says this represents the house. So this is this. It's pretty much the same thing. These are the same thing. This is the mortgage. There's a separate document that's the promissory note. I promise to pay. If I don't pay, enforce whatever the mortgage says. Mortgage says, well, there is a house located on whatever street, and here's the block and lot and whatever it is, right? So this has all the description of the property. And if I don't pay, you can take this to court in order to recover this or whatever monies you can. You understand? So there's two documents always. Two documents. One represents the loan, one represents the house. Promissory note, loan. Mortgage, house. Okay? You good? Okay. All right. Great. Because now it's going to start getting confusing. Just now. It hasn't yet. I mean, okay? So for 16 chapters, it's been easy. Now it's going to get confusing. Let's talk about the mechanics of a loan transaction. And we're going to learn a crazy word. That crazy word is hypothecation. All right, so it is common to use borrowed money to purchase real estate. When a borrower gives a note promising to repay the borrowed money and executes a mortgage on real estate for which the money is being borrowed as a security. The financing method is called mortgage financing. The term mortgage financing also applies to real estate loans secured by a deed of trust. We'll talk about that later. And the process of securing a loan, so getting a loan, right, by pledging property, as we said before, the process of securing a loan by pledging property, that means we're saying, hey, here's the property in exchange for money, right? Pledging the property, but without giving up ownership. So I'm telling you, this is the house. I'm giving it to you, but I'm really not giving it to you, right? So it's the house. That's what I need the loan for. It's worth $300,000, but I'm really not giving to you. What I'm giving you is a paper that says if I don't pay, you come get the house. Until then, I get to use it. Until then, you have no way to getting into the house without my authorization, unless I default on the loan. So, the process of securing a loan or getting a loan against a property without giving up the ownership of the property is called hypothecation. Okay? So the process of pledging property without giving it up is called hypothecation. So you have a car, you drive the car, you finance the car, you hypothecate it. You have a house, you live in the house, you maintain the house, you pay taxes, all that stuff, you hypothecate it. As long as there's financing against that secured item that you keep on using while paying, it's called hypothecation. Now, let's say I need money. I have a phone. This phone is worth $1,000. I go to the bank and I say, bank, hey, could you lend me money? Here's my collateral. It's the phone. It's $1,000. Could you lend me some money? The bank says, I'll give you $600 right now, right? At 10% interest. As soon as you pay it back, you get your phone back, right? That's not hypothecation. Hypothecation is, I need money. Here's the collateral. I'm still going to use it while I pay. You guys got it? That's what hypothecation is. A loan where you pledge the property and stays there with the lender, whoever gave you the money, stays there until you pay it back, it's not hypothecation. Hypothecation is you got a loan and you get to keep the property while paying the loan. Any questions on that? I mean, if you have questions before I proceed. Nina is not on camera, so I assume there's a question coming. Question mark. Yeah, there. Oh, there you go. Question mark. I'm so happy. Question. Your time. Don't worry about us. Oh, Fallon has a question. If you're paying off a cell phone in installments, is that the same thing? Kinda. Yep. If it's financed and you get to keep the property, yes. Kind of the same thing. Fallon, rent to own? No. Because in a rent to own, you're paying rent. It's not financed. After a year or two, when you decide to exercise the option to buy, then it could be financed or you're purchasing in full. Once it becomes financed is when you have this option. So until then, you're renting the property. Renting and financing are two separate things. Renting is I'm renting, paying $1,000 a month, and I have the option a year from now to buy or not buy. If I decide to... Okay. I get this question all the time, by the way. People get confused with rent to own and seller financing. Yep. So in this case, no. Rent is rent. Like a flat fee you pay every month, and there's no interest added to it. So therefore, it's not financing. If it's not financing, then there's no loan. If there's no loan, there's no hypothecation. Okay. And here's the good news. We're still on page 1. Now, but you see why it's important to go slow on this? And we just started. Okay? Next, states differ in their interpretation of who owns mortgage property. Those that regard the mortgage as a lien held by the mortgagee, the lender, against the property owned by the mortgagor, the borrower, are called lien theory states. So if there's a mortgage, lien theory. Those that regard a mortgage document as a conveyance of ownership from the mortgagor to the mortgagee are called title theory states. Some states interpret ownership of mortgage property from a point of view that combines the aspects of both title and lien theory. A valid mortgage or trust deed financing arrangement requires a note as evidence of the debt and a mortgage or trust deed as evidence of the collateral pledge. So it's what I was showing you here. What is the note? Note or promissory note. I'm not going to read the whole thing because I already explained. But a promissory note is the personal liability. Promissory note is the personal liability. Okay? The promissory note is what says, if I don't pay, you can come after me. That's it. Take the house and whatever's left, right? Because just like a repo, when they repo the car, right? When they repo the car, they sell it at an auction. If there's enough to satisfy the loan, great, they don't hunt you down. Done. If there's not enough, they can still come after more, even though you don't have the car anymore. The promissory note is what gives that personal liability, where they can hunt you down for more money if there was not enough to satisfy in foreclosure. The mortgage, as I said before, the mortgage is where you pledge the real estate as collateral. The mortgage, as I said, is where you pledge the real estate as collateral. You're promising that this is you're giving up the property to the bank as a collateral. If you don't pay, they can come and get the property. Okay. Once they sell the property in auction, if there's enough money, great. If there's not enough money, again, because of the promissory notes, they're entitled to come after you for the difference, right? So promissory note, personal liability. Mortgage is the collateral. Now we have this word right here, mortgagor, and then we have a mortgagee. Guys, without reading, let me know, what do you know about this word? Who is the mortgagor? Let me know, who is the mortgagor? The one giving the mortgage. Great answer, Nina. Who's the one giving the mortgage? Bank, lender. Nina, who's the one giving the mortgage? Anybody else? If you're watching on YouTube, you're welcome to participate and answer these questions. Who's the mortgagor? Everybody answer already? So if your answer is missing, who's the mortgagor? Right? Arlene, try to answer in the Zoom if you can. There's a Zoom chat in the right on your screen somewhere here on your screen. It should give an option when you click, pops up the chat. But okay, with that being said, we're moving forward. We got all our answers. And here you go. Let's figure out who the mortgagor is. Ready? You're going to draw this. So 2 columns and 1, 2, 3 rows. Give enough space here to write 4 things. Okay. I'm going to zoom in a second. Just for now, 2 columns, 3 rows, and here enough space for you to write 4 things. Okay. Now, right here, this column says gives up property. This column says receives property. Let's look right here. In this column, we have the grantor. Grantor is the seller. In this column, we have the grantee. Grantee is the buyer. In this column, we have the lessor, or the landlord. In this column, we have the lessee, or the tenant. I'm just showing you that there's a pattern here. Whoever gives up the property is the OR, the grantor, the lessor gives up the property, right? Whoever receives the property is the E, grantee, lessee. Okay, good so far? we're going to go into mortgagor. Remember I said that there's two documents. One is the mortgage, the other one is the promissory note, right? And I told you that for you to get your money, you need to give up the house. So who is the one that gives up the house? Who gives up the property? It's the mortgagor. The mortgagor gives up the property. Well, do you think the bank is going to give up the property? No. The borrower says, hey, bank, lend me money to buy the house, and I'll give up the house for 30 years to you, represented by this piece of paper. So I'll give up the house for 30 years. So who's giving up the property? The borrower. The borrower who's about to be the owner. So OR is short for owner. See? OR, short for owner. The mortgagee is the lender. Okay? Another way you guys can see this to help, if it helps, is that mortgagor has two O's. Let me just zoom in real quick. Mortgagor has two O's. Borrower has two O's. Mortgagee has two E's. Lender has two E's. So whatever way it works for you, I prefer understanding who gives up the property, and that's the owner or whoever is about to be the owner. He or she is the one that gives up the property in exchange for money. You guys look here. Doesn't the grantor give up the property for the grantee to receive it? Doesn't the seller give up the property for the buyer to receive it? Okay. Doesn't the landlord, the tenant, the landlord give up the property so that the tenant can receive it? Right? I give up the property temporarily to my tenants. They occupy for a year, for 5 years, for 10 years, but it's still my property, but I'm giving up the possession at that moment. So as a borrower, you giving up your property for the lender to receive it. And what does the lender give you, or all these E's give you? They give up money, and you, owner, receive the money. So remember, whoever gives up the property and receives money, that's this column right here. Whoever gives up the property and receives money, so if you don't get it in one way, get it in the other, is whoever receives the money is the OR, the owner. Okay? Whoever receives the property but gives up money is the E, tenants. They give up money every month. Buyers, they give up money to buy. Lenders, they give up money to lend. Try one more time. Seller sells the property, receives money. Landlord rents the property, receives money. Borrower gives up the property through the mortgage document and receives the loan to buy that particular property. Let me know if you have questions. No questions? In a little bit, I'm going to ask you who's the mortgagor. And you will still tell me it's the bank. I want to make sure you guys understand the mortgagor is the borrower. Mortgagee is the lender. Right? Because what happens is a lot in the real world, what we do, and the reason why I want to stay here for a second, what we do is like, hey, Fallon, you want to buy a house? Let's see if we can get you a mortgage, right? It's tradition. We say it that way, right? Everybody says it that way. We're gonna get you a mortgage. No, what we're gonna get you is a mortgage loan because you're the one giving the mortgage. Remember, you're the one giving the house. Mortgage equals house. You give the house as collateral. What the bank gives you is a mortgage loan, so financing to purchase. You got it? So that's why it gets confusing because of the way we express ourselves in real life versus the technicalities, right? So we say a lot of stuff that's incorrect all the time. Like when we talk, there's a lot of things that we say incorrectly because it becomes acceptable that way, right? So hopefully we got this out of the way. Now, flow of funds and obligations in the mortgage transaction are as follows. So how do things begin? There's a mortgagor that prepares a note and mortgage, and there's a mortgagee that gives the loan amount. Now, guys, who's the mortgagor? All right, everybody should be able to answer this in 2 seconds. All right, no thoughts about it. Just throw it at me in the Zoom chat, please. Ah, there you go. Now we're getting somewhere. Correct. The borrower is the mortgagor. So the mortgagor gives the note and mortgage to the bank and says, hey, I promise to pay if I don't enforce the terms of the mortgage, like take my house, right? Who is the mortgagee? Who's the mortgagee? Correct. The bank or the lender. Absolutely correct. There you go. And the bank, in turn, gives the loan amount to the borrower. Okay? Now, fulfillment. Fulfillment means you completed the terms of the note and mortgage. Fulfillment means you paid off. So what happens now? The mortgagor makes payments to the mortgagee, right? And the mortgagee over time starts releasing that grip they have, and once the balance reaches zero, the mortgagee, the lender, must cancel the note and the lien, the mortgage obligation. So they must release that from the mortgagor's property. Okay, and that's how it works. Very simple. Very simple. Okay, borrower gives up the house, bank gives money. Borrower makes payments. Once it's paid off, bank releases the note and mortgage that was given before. Simple. Question from Nina. Is the lender always a bank or can it be someone else? Did you notice that I made a distinction here? I put bank and I put lender. I'm not a bank, but can I lend to you? The concept is the same. Okay? So can it be someone else, another entity? Sure, it doesn't have to be a bank. It's whoever lends, it will always be known as the mortgagee. Okay. Next, we have deed of trust. Hold on. Felix is asking a question. I see the computer shaking, but nothing's coming through. Don't kill the computer. Just type fast. That's it. Don't go like, doing all bedrock on me right here, like Flintstone. Get a Dictabird. Flintstones, no. So when it comes to, put up here, green. When it comes to mortgage, that mortgagee becomes lender and not a borrower, given the fact that normally tenants. Who is it? Is it when they? Sorry, I'm trying to decode what you're trying to ask here. I'm a little lost on this. Comes to the mortgage. Mortgagee is the lender, period. Or given effect normally. I'm not getting the part of tenants being lenders. That's the part that's like throwing me off in your question. Because the mortgage comes from the borrower. Mortgagee is the lender. So a little lost on that question. If anybody gets what the question is and wants to chime in, I'll take it. He keeps on looking to the side. Is that your notes or questions you're getting from Google? He goes on Google like questions to ask Bruno. Is that it or no? Waiting. I know. I'm horrible. I get it. Excuse me, Francielli. Sometimes it's better this way. All right, let's see. So what I'm trying to say. No, I agree, Francielli. Sometimes it's better that way. Sorry, I have a message here on the side. So, Felix, what I'm trying to say is, as far as this chapter with mortgage. Wait, so you were typing for half an hour to write three lines or 4 lines? Just messing with you. So, what I'm trying to say is, as far as this chapter with mortgage, is the mortgagee always the lender, or is it applied to real estate in general? Mortgagee, that means there's financing involved. So it applies to all type of financing that is secured by a property. So there's a mortgagee, or as we're going to go over right now, there's the deed of trust. So it'll be the trustee and the beneficiary of the trust. But mortgagee means there's some type of lending involved. Okay? With tenants, they are lessees. That's what I was showing you here. Tenants don't lend money. The tenants they are the renters. So they are the lessees. Okay, so these are the different categories. We have a seller, landlord, borrower, buyer, tenant, lender. So grantee, right, that receives the property, lessee that receives the property, and mortgagee that receives the property. So mortgagee, yes, whoever lends money to you. If you're getting your tenants to lend you money, something is wrong in that relationship. You got it? So going back to your question, is it always a lender? Yes. Mortgagee, always a lender. Okay? Good? Okay, cool. By the way, I'm joking with a whole half an hour to do this. Like, Nina does it in 2 seconds because she has already a whole library of questions ready for me. So she just copy, paste, and boom. Bruno, deal with it. You know? So all right. Now, just so you know, Felix, it's good to know that we have people out on YouTube that are watching us and only make comments as far as, please open the mic, let Felix ask the question, right? Versus, hey, Bruno, I have a question, you know? The next time, Felix, just to please some of our viewers on YouTube, I will give you the mic, right? I guess Francielli did not like the Jeopardy game show song going on. That's funny. All right. Next, we talked about mortgage. We're going to talk about deed of trust. What I want you to write is that deed of trust is similar to a mortgage, in that a deed of trust, like a mortgage, conveys the property somehow or transfers the property somehow to somebody else. Remember, if you have a mortgage, you give up the house, right? If you have a deed of trust, it operates like the title of your car. You get the money, but you give up the car, right? You get the money to buy the car, but you give up the car. And you only get the deed to transfer to your name later on, right? So you get the title later on. In this case, a deed of trust, which is not used in every state, right? So as we said, we have the lien theory states, mortgages, and we have the title theory states, which use the deed of trust. Now, a deed of trust conveys or transfers title to the property in question from the borrower. In this case, instead of being a mortgagor, the borrower is the trustor, right? To a trustee as a security for the loan. A trustee is a third party. I'm going to show you that in a second. It's a third party that is fiduciary to the trust. You want me to repeat that again? That again. What do you want me to repeat? That it's similar to a mortgage, that it's used in certain states. Oh, the theory part. So going back up on the previous page, we have lien theory and we have title theory states. State exam, they don't ask you what's a lien theory, what's a title theory. But in state exam, you need to know what is a mortgage and what is a deed of trust. So that's what I'm trying to show you here. That in lien theories, we have a mortgage, which is the lien. In title theory states, we use the deed of trust. So what happens is, while the loan is in place, the trustee holds the title on behalf of the lender, who is the beneficiary of the trust. On repayment of the loan, the borrower receives the title from the trustee in the form of a deed of reconveyance. So I'm going to show you right now how it works versus the mortgage. Actually, let's go back here. Mortgage is this way. I give up the house to the lender. Lender gives me money. I pay off the money. Lender releases the lien. Right? So this is right here is a lien. You guys know that. Releases the lien. With a deed of trust, the way things work is we have the borrower, again, trustor, OR, right? Again, the OR is there. That's why it's key for you guys to understand who is the OR, is the owner. So the borrower executes a deed of trust to a trustee. The trustee is a third party. It's not the lender. It's someone else. So I'm giving title, like the car, I'm giving the title to somebody else. So let's say it's my house. I'm borrowing money, and I'm going to give the title to Amy. Amy, you're the trustee. But who lent money to me? It wasn't Amy. It was Bank of America. Bank of America in this case, Bank of America is the beneficiary. So bank gives me money, and I give the note, promissory note, the IOU. Right? So you guys remember the mortgage? This is very similar to the mortgage. The difference is, instead of me giving the mortgage to the bank, I'm giving it to a third party while I make payments on the loan. You got it? So somebody else holds the paper. Somebody else holds, right? So there's now three parties. I give this to the trustee, so to Amy. Amy, here, you're the one holding the mortgage, in this case, deed of trust, right? And then there's a separate document that says I owe you, and I give that to Bank of America. I say, hey, Bank of America, I'm going to pay you. If I don't pay you, Amy can take action against the house, and whatever money Amy recovers gives to you. So there's three parties involved. There's the borrower, there's the lender, and there's a trustee. Okay? Once we finish paying off the loan, again, borrower, bank, third party. Once we finish paying off the loan, so we finished all the payments to the bank, the balance is now zero, right? We pay the bank, the balance reaches zero. The trustee, this third party, or Amy in this scenario, is going to give us the title to the property. Same thing as a car, right? At the end of you paying the car, you get to use the car, you're paying in installments, and at the end, what do? They transfer the title, or the deed in this case, they reconvey it or retransfer back to you. Okay? So this happens in title theory states or non-judicial states. Judicial states, we use liens, so mortgage. What is the biggest difference between these? Hold on, Francielli, I'll address that in a second. So what is the biggest difference between these? Is that when there's a trustee versus the mortgagee, we can go to foreclosure way faster. So the lien theory states, like New Jersey as an example, we have to go through court to enforce the mortgage. The title theory states, just like a car, they can just show up and repo your car. Oh, you missed 3 payments? Don't worry. Here comes the towing company. It's almost the same thing. I don't have to go to court. I don't have to go to court because the title is not yours anyway. You understand? So in some states, that's how it works. If you don't pay, they repo the house, meaning they go straight to auction. In other states, like here in New Jersey, if you don't pay, they have to take you to foreclosure, which could take a year, 2 years, 3 years, 10 years, depending on how crazy the system is right now, right? In these title theory states, like the, let's say Virginia, right? Then you know what? I just have to announce the auction. It's been 3 months that you don't pay me, I'll announce the auction. So 2 months or 3 months from now, there's going to be an auction. Simple. We don't wait for courts to tell us what to do. Again, very similar to the way it works with cars here in New Jersey. Felix has a question, and then I'm going to go to Francella's question as well. Felix, what is the point of involving a third party when you could work with the bank straight up? Like I said, it depends on the state that you're in. In New Jersey, for instance, we don't have title theory type of liens. So, I'm sorry, title theory mortgages. So, there are some states that are hybrids, which allow the bank to choose which format they would like. For the bank, it's easy. The decision is easy. If you don't pay, in this scenario, they recover the property real fast. If you don't pay, in this scenario, again, it could take 1 year, 2 years, 3 years, 10 years, right? So the question is not, why would you work with a third party versus a bank? No. The question is, why would the bank want this versus the quick recovery? It's not you, it's the bank that decides what they want to do depending on the state they're in. You understand? So, yeah, Nina, they do give you a warning. The process is, hold on. So the process is more or less this, and this is going to be a quick representation because not heavily tested. So in the first 60 to 90 days, you guys don't have to write this down. I'm just showing you what happens in real life in one versus the other, okay? So let's say you stop paying the first 60 to 90 days. They keep on sending you notices saying, hey, you forgot your payments. Like, just in case you remember you do have to pay, right? So they keep on giving you notices. When it gets to the 90th day, 60th or 90th day, according to law, you can now take an action. So they take you to court and they file what's called a summons. This is here in a judicial state, so New Jersey. They file what's called a summons and complaint for foreclosure. Okay. So now that they filed the summons and complaint for foreclosure, we are in foreclosure court. Okay, and this could take anywhere between 1 year to 3 years standard. Currently in the state of New Jersey, on average, is taking 3 years. But I know some people that stayed in their house almost 10 years. So they were able to keep on pushing, negotiating with the lender and so on, and this kept on pushing. Or the court was so tight in certain areas, so tied up in certain areas, that they kept on rescheduling the process, the hearings, right? So it goes 1 to 3 years. And then after the court decides, so after the 1 to 3 years, the court is going to have something called a writ of execution. And a writ is an order. So order or writ of execution. So a writ is an order, and the judge says, hey, sheriff, sell this property at auction because they defaulted. So there's a judgment already somewhere around here. There's a judgment. And because the person losing the home does not take action, after a while, the judge says, let's force the sale then. Since the defendant does not take action, we're going to force the sale. So now what the sheriff does is schedule auction. And sometimes it's 60 to 90 days notice. And then we have here a sheriff sale. All right, so this is the whole process in judicial states. This is what's going to happen. So in judicial states, if you default, 60 to 90 days later, without paying, they file a summons and complaint in court. They take it to foreclosure court, which could take 1 year, 2 years, 3 years, 4, even more, depending on how we fight or not, right? So if you don't do anything, it's going to take roughly 3 years right now. The judge issues an order. The sheriff gets the order and schedules an auction, right? In a non-judicial state, this is what happens. We bypass the whole court. So we wait 60 to 90 days before we say, hey, I'm the trustee and you haven't paid. So we're going to schedule an auction in the next 60 to 90 days. Could even be more, but let's say 60 to 90 days, right? So the trustee gives you a heads up. Yes, Nina, gives you a heads up that says we're going to auction. So it's way faster. The difference for the lender, it's a great benefit because they can recover the property way faster with a deed of trust versus a mortgage. That's pretty much the biggest difference between these. You got it? Thumbs up? Great. Francielli's question, is that the reason why our deed doesn't have our name? So the deed in New Jersey, if you are in New Jersey, the deed has your name. The deed is in your name in the state of New Jersey. In other states, non-judicial states, it might say deed of trust. That means that a trustee holds the title to the property, right? But in New Jersey, the deed has your name. If you pull the deed on your house, guys, the deed has your name. Judicial states, traditionally, the deed has your name. What you will have also attached to the property, if you pull the records, we'll have also attached to the property is a mortgage that's filed against the property. That mortgage is the lien, right? So that will be there somewhere. But it does have your name. By the way, Francielli, if you're still watching, waiting on you to bring those papers that we talked about. Just saying. You're asking me questions. All right. Now, this is true whether it's a deed of trust or a mortgage. There's a principle. And when we're saying principle here is different than the principle in agency or law of agency. Principle is the capital amount borrowed, is the loan principal. Francielli, I know you're there. I just wanted to make sure you heard what I said. You just wrote on YouTube, I am here. Like, I'm here too. Waiting on the stuff we talked about. Saying, holding you accountable, because that's what I like to do. All right, so principal, amount of money borrowed. Interest is the charge for the use of the lender's money. So there's principal and there's interest. Principal is the amount of money that you borrowed or the loan balance. So as you pay it off, right, it reduces the principal amount owed. Interest, when you see interest, when it comes to financing, interest is the charge or the fee that the bank charges you for using their money. So the longer it takes for you to pay back, the more you pay in interest. The faster you pay the house back, the less interest you pay. All right? So interest is a charge for use of the money during a certain period of time. Now, because the interest rate on a mortgage loan does not reflect the full cost of the loan to the borrower, federal law requires the lender on a residential property to compute and disclose the APR. So federal law requires, so the bank has to disclose the APR. And that includes other finance charges in addition to the basic interest rate in the calculation. What am I trying to say here? Very simple. If I go to Bank of America and I go to Wells Fargo, Bank of America says, hey, interest rate is 5%. Wells Fargo says, hey, interest rate is 5%. Guys, what's the difference between these two? If the pure interest rate or the basic interest rate is 5% on both, what is the difference between the two? The difference is APR. See, at Bank of America, my APR could be 519. At Wells Fargo, my APR could be 524. That means there's a 0.05% extra with going with one bank versus the other. So that's why every credit card says APR, right? Every loan says APR. So definitely mortgages have to say APR as well. It's the annual percentage rate. It's different than basic interest. And what is the difference, you might ask? The difference is that APR, again, APR includes other finance charges. So what are other finance charges? Whatever they want. Whatever it costs them to carry over the loan for 30 years. Do they intend to sell the loan? If yes, then there might be a charge, there might not be a charge. Do they intend to service the loan? If yes, there might be a charge, there might not be a charge. So they want to put appraisal fees. They want to do forced insurance onto you. Whatever the reason might be. I'm just saying there's several charges that each lender can charge. Documentation fee. Why are you calling customer service fee? Those could all be added to finance charges. It's the cost to carrying the loan. And every lender has their own APR. So 5% of Wells Fargo, 5% of Bank of America, even though they seem like they're the same, unless you have the APR annual percentage rate, you really do not know how much they charge. So again, federal law requires the lender to let you know what this is. Why do you need to know the actual APR? One of the reasons, besides basic APR, one of the reasons is this. Usury. That's one of the reasons they have to let you know the APR. Because, for instance, in New Jersey, usury is 16%. That's the max that we can charge. So anything above that is usury. If 16% is the basic interest, but APR is 16.25, that's it. They fall under usury, which is where they use and abuse you. Usury, and one easy way to remember, use and abuse you. They know if you pay 16% or more, you will not be able to pay back the loan. So if I lend you money knowing that you'll not be able to pay me back, you understand what I'm saying? That is illegal. So usury is an excessive interest. It's a charging of excessive interest, knowing that it's almost impossible for you to pay it back. Felix, you don't. You don't calculate the APR. They are forced to explain to you what their APR is. There's no way for you to calculate because it's bank charges. Right? I'll give you an example. The fee that you pay for the school, includes the credit card fees and transfer fees to the bank. So that's my final price. Some schools, they charge you an additional $5, $10, $20 fee for processing. So everybody has different methods of operating. Does that make sense? So Bank of America might not charge you for a bunch of fees that Wells Fargo does. Those are all added to the finance charges. So you don't get to calculate. There's no way for you as an individual to calculate what the APR is. They have to tell you, it's required that they tell you what the APR is. All right? Next, we have points. Point is 1% of loan amount, not the purchase price. Okay? So a point, 1 point equals 1% of loan amount. Of loan amount, not of the purchase price, of loan amount. I'll explain better in a second. But right now, just write. Points, 1 point equals 1% of loan amount, not the purchase price. So if they charge you 2 points, it's 2% of the loan. If they charge you 3 points, it's 3% of the loan. If they charge you 10 points, it's 10% of the loan. Okay? Never, ever, ever apply the points to the purchase price. So, from the point of view of a lender or investor, the amount loaned in a mortgage loan is the lender's capital investment, and the interest paid by the borrower is the return earned by the invested capital. It is often the case that a lender needs to earn a greater return than the interest rate alone provides. For example, a lender may require additional yield in low interest VA loan, which has an interest rate maximum. In such a case, the lender charges upfront. These are upfront, not over the course of the loan. Upfront discount points to make up the difference between interest rate and the loan and the required return. A discount point, again, is 1% of the loan amount. A discount point, what we just wrote, is 1% of the loan amount. So 1 point on a $100,000 loan equals $1,000. All right? 1 point or 1% on a $100,000 loan equals $1,000. So they're asking you up front to pay $1,000 up front to reduce the interest rates. The value of 1 discount point to a lender is usually estimated equivalent to raising the interest rate on the loan by 1/8. Thus, a lender has to charge 8 points to raise the yield by 1%. I'm not going to get too deep into this. I'm going to show you just something else that's a lot easier for the state exam. But this is what you need to know. For 1% to be reduced, you have to pay, as it says here, 8 points. So it's 1/8. Every time you pay 1/8, it reduces a percentage. If the lender wants to earn 7% on a loan offered at 6.5%, the number of points necessary would be figured out as follows. 7% minus 6.5 is 0.5%. 0.5% times 8, that 1/8, right? Times 8 means 4 points. For state exam, they would tell you, on a loan of $100,000, the lender is asking for 4 points. How much does the borrower have to bring to meet that requirement? That would be the question. What's highlighted here would be the question. Usually in the state exam, they don't ask you this. If you're taking the mortgage class and you're going for the mortgage loan originator license, then yes, you need to know this. For a state exam, as a salesperson, you have to understand the basics, but the question will be, on a loan of $100,000, the lender's charging 4%. How much cash would the borrower need to meet this requirement? $100,000 times 4% or 0.04, I will have to bring $4,000. Okay? Now, why did we pay the points up front? Why would we pay the points up front? Again, because the interest rate was 7% and we're trying to drop it to 6.5%. So we pay $4,000 up front to have a lifetime loan, 30-year loan at 6.5%. Okay, the reason why you paid $4,000 up front is to save that 0.5% over the 30 years. That 0.5% over 30 years could be equivalent to $30,000, as an example. Is it worth the investment? You pay $4,000 up front to save 30? Yes? Maybe. Showing you raw numbers? Yeah. Anywhere I put 4,000, I make 30,000 out of it is a great deal. Yeah, sure. But if you stay in the property, for 5 years, did you recover your money? Probably not. The $200 savings that you had every month over the next 5 years might not amount to 4,000. You understand? So your interest rate is lower, your monthly payment is lower, but how long does it take to recover? If you intend to stay there for 30 years, you're going to get back 30, right? 30 minus your $4,000, you saved a total of $26,000 over 30 years. You understand? Over 5 years, did you get your money back? So it makes no sense. Everything is great. I'm telling you this. Every single product out there, financial product, every single investment is great, depending on what your intentions are, what your needs are. That's why both the loan officer advertising points and the realtor talking about a house should be concerned more about the clients and understanding their needs, right? And even a professional talking about retirement, right? I do that as well. So if I'm talking about your retirement and preparing yourself towards retirement, I need to understand what your needs, your wants and needs are. Not just say, oh, you want $1 million policy? Sure, I'll get you an insurance of $1 million. Well, is that what you need? Or is that what you want? I can show you how to raise the $1 million with another type of policy that you can tap into and have cash value. Right? Do you see what I'm trying to get at? Well, these professionals, so us realtors, loan officers, insurance professionals, whoever's in the financial realm has a fiduciary duty to their client. You guys should know fiduciary by now. Has a fiduciary duty to their clients to explain how things offset over time. And is it worth it to do it this way versus not doing it at all, right? So what way would be best for the client? All right, so understanding these basics are great. I had people ask me, well, Bruno, why are they charging me all these points? And I said, well, I don't know. I'm not the one doing the loan. Well, let's find out. So again, not my monkey, right? Because I don't do the mortgages, so not my monkey. So I called the loan officer and I say, hey, listen, client's asking why they're being charged. I forgot how many points it was at the time. This is a couple of years ago. They're asking me why they're being charged these points. And the loan officer goes like, well, I did explain to them, right, this particular loan officer, I explained to them that their rate is going to be X amount of dollars, but if they put an additional, it was 32 or 36, 32 or 3600 up front, it will save them $200 every month over the next 30 years, right? So I asked that and I said, listen, can you please get on the call with a client, right, with our mutual clients, and explain that. I'll stay on the phone with you. We'll do a three-way call, and we'll explain all this stuff, all right? This way, we're all on the same page. Everybody's in understanding of what the points are and what the benefit is if they do ask me again. And that's what we did. So we had to explain again the trade-off, why we paying $4,000 up front to reduce the interest rate and get these savings. We had to explain it again. But most people, they're not explained. Oh, I'm charging you points. Why? Let me know why I need to come up with more money, right? So guys, you need to understand these basics. Can you repeat all that again? You know we're about to go into a break, right? Just kidding. All right, can I repeat all that again? The math part. Yeah, I can. All right. Actually, by the way, I have a video on YouTube. There's just about points. Just letting you know. So it's like a whole video. If you have questions, search about points. And it explains it all. I'm just trying to see if I have an explanation here real quick. Gotta have it, come on. Yep. So let's say we're buying the house. We're buying a house for 360,000. Okay, you're buying the house for 360,000, and the bank says we're going to give you 80% of the loan, right? So it's an 80% LTV. This is the purchase price. 80% LTV is loan to value. So that means your down payment is 20%. Okay, good so far? 80 plus 20 meets 100% purchase price, right? They put 20% down payment. If I'm putting 20% down payment, how much is the loan amount, right? So we're going to take 20% out. How much is the loan amount? Now, I'm going to throw numbers. Don't get too much into the actual correct numbers. That's not what I'm doing. What I'm trying to show here is one simple thing. Let's say this right here is $60,000, whatever. Then what's the balance? What is the loan amount? If I put $60,000 as a down payment, what is the loan amount? The loan amount now is $300,000. If the bank is charging you 2 points, if the bank is charging you 2 points, that's 2%. Of what? Is it 2% of the 360? Or is it 2% of the 300 loan? And the answer is 2% of the loan amount. Why would you pay those 2%? To reduce the interest rate from 6.25 for 30 years to 6% for 30 years. You got it? So you reduced 0.25% here. Good so far? Great. How much did it cost you? The 2%, the 2 points. It cost you $6,000. That's what you pay up front to save 0.25 over 30 years. Right? And just, these are wild numbers. These are not the exact numbers, okay? But let's say you saved $50 over 30 years. That's the difference between 6.25% and 6%. Let's say, again, these are not correct numbers. I just threw numbers out here, okay? But the idea is the same. So let's say it's $50 the difference every month. Over 360, that's $18,000 that you saved over time, right? But how much did you put in? You only put in $6,000. Over 30 years, you saved 18 minus your initial investment. Your actual savings was $12,000. So the idea of paying points up front is to be able to reduce the interest rate for those for the term of the loan. So you pay upfront 2 points, 3 points, 10 points, whatever the bank charges, in order to reduce the lifetime of the loan interest rate. Good so far? Okay, great. And again, the only thing I was trying to say is this worth it? Is it worth putting $6,000, right, to save $12,000 in total? It depends. Over the lifetime, maybe. If you're there for a short period of time, you could have done other things with that $6,000. You understand? So that's pretty much what it is. Oh, what's 360? 360 is 30-year loan times 12 months in each year, 360. So we have 360 payments. Like I was saying, you saved $50 in that difference. You saved $50 a month. You paid $6,000 to save $50 a month over 360 payments. If it was a 25-year loan, it was 300 payments. Okay? If it was a 15-year loan, it's 240 payments. So it's divide the years by 12, or I'm sorry, multiply the years by 12, and it tells you how many payments you have in a loan. Okay? All right, so term. Term is the period of time. So if I have a 15-year loan, the term is 15 years. If I have a 30-year loan, the term is 30 years. Obvious. Payments. So the payments will have the loan term, loan amount, interest rate combined to determine the periodic payments. And we already talked about promissory notes. The promissory note, the document itself, promissory note, includes everything regarding the loan, because you know the promissory note is the loan. It's the IOU, right? So promissory loan note is the loan. It's your promise to pay. So obviously it's going to include the loan amount. It's going to include the term of the loan. It's going to include the method and time of repayment. It's going to include the interest rate to be paid and the borrower's promise to pay. The mortgage is the house or the collateral. So we already covered this, right? So the mortgage document is going to include, one of the things that's very important to include is the legal description. You guys remember the 3 methods of legal description that we must have? Or, I'm sorry, that we could have? The 3 methods of legal description? Let me know in the chat. 3 methods of legal description. Three methods of legal description. What we got? Meets and bounds. Great. Price is not a legal description. That's a fee that they have to pay. Talking about legal description. What legally describes the property? Government survey method. Yep. And plat. Perfect. So we have meets and bounds. We have government survey method or rectangular survey system. And we have the plat of subdivision. These are legal descriptions of the property. And these must be included. These must be included with every single document that is to be recorded against a particular parcel of land, right? Now, yes, Olga had written price. In this document, you have to have also the debt amount, not the price itself, because that's the purchase price, but you have to have the amount of the debt, which gives a value to the house. So I bought the house. Yep, Francielli, perfect. So I bought the house for $300,000, but the loan is $280,000. So I'm going to put $280,000 as the lien against the property, because the lien is whatever's left, right? So $280,000 against the property is going to be right there. And for how long? For 30 years. What kind of method and timing of payments are going to be there? In the mortgage, it does not provide the details about interest rate, charges, and all that stuff. It does not. It just shows legal description and debt amount, term, so for how many years, method and timing of payments. Okay, monthly, bi-weekly, whatever it might be. In the next page, the mortgage document, and I'm sorry, the loan has to include also a notice about escrow. What is escrow? Taxes and insurance. Every time you see taxes and insurance relating to mortgage, it's called escrow funds. Okay, so funds for escrow or escrow funds. That means your monthly payment is going to include principal, interest, taxes, and insurance. Principal, interest, taxes, and insurance. PITI or PD payments. The first payment, the first portion of your payment goes towards taxes and insurance, then goes towards interest, and whatever's left goes towards principal. But these are your PD payments for taxes and insurance. Escrow account. Escrow funds. Okay? Right? Tell me you're good so far. Give me a thumbs up. Great. Great. All right, cover all this. So we're almost to the break. So, mortgage insurance. Has anybody ever heard of PMI before? PMI, private mortgage insurance? Okay, one person. Two, that's it? Okay. So what is PMI? Not TMI, right? PMI. PMI, right there. Private mortgage insurance. That means you're not putting enough as a down payment. So the bank says, well, the ideal down payment is 20 to 25%. You're only putting 5% down. So I need something to cover the difference. What we're going to do, we're going to insure the difference. Meaning, if you ever default, if we ever go through foreclosure, I'm covered at least 20 to 25%, says the lender. All right? So private mortgage insurance usually applies only to conventional loans or traditional loans. It does not apply to loans that are backed by Federal Housing Administration or by VA. Okay, so PMI is only for conventional loans. It's not for FHA or VA loans. And this happens every time you put a down payment that's less than 20%, as it says right here. Again, private mortgage insurance. That means it's a private insurance company insuring the bank that if you default, they're covered. Right? And that's different from MIP, which is, a lot of people don't know what MIP is. They think PMI is for FHA as well. No, FHA has MIP, which is mortgage insurance premium. It's built in that type of program. It's built in an insurance towards default of mortgage. So it's very similar. They operate the same way. The difference is that this one is private, and MIP, because it's FHA, MIP is I got you, Landry. MIP is government insurance. Okay, so private insurance, government insurance. PMI, MIP. In real life, just like saying, hey, we're going to get you a mortgage, we also say you got PMI on your FHA, right? A lot of people don't know how to talk about the difference between these two. Even loan officers sometimes don't know the difference. They just say, hey, you got PMI here. But FHA is MIP. It's different. Same concept. It's when you put less than 20%, but different term. Okay. In the next page, we talk about transfer of property or beneficial interest in borrower. So right here, when we sell the property, we're selling it to somebody that is not part of the property, right? So let's say I'm the owner of record. I have legal title, right? I have legal title on the property. And then I'm going to sell it to Olga. Olga, I'm selling my property to you. If I have a mortgage loan with Bank of America knows me. Does Bank of America know you, Olga? No. So because Bank of America does not know you, you are an alien, right? You're a foreigner or foreign to the bank. So bank does not recognize you. If I sell the property to you, then you become the legal owner. The legal title transfers to your name, correct? The bank has the right to exercise what's called a alienation clause. An alienation clause is also known as due on sale clause. What does that mean? Well, Bank of America says, Bruno, according to the mortgage document that you signed, if you ever sell this property to somebody else, the entire balance of the mortgage, whatever the balance is, let's say $100,000 balance, is due at the time of the sale. So Olga cannot take over your mortgage payments. You have to pay us off and let Olga get her own mortgage with Bank of America, with Chase, with TD Bank, with whoever. But yours must be paid. So the seller must pay the balance in full. You got it? The seller must pay the balance in full if the bank exercises the due on sale clause, also known as alienation clause, right? Alienation, foreigner, anybody that comes to the land and becomes part of the land when they were not there before. Okay. Melissa, I don't know why you're showing as ED, but you're asking which one is better. I assume you're talking about PMI or MIP. Let me know if that's your question. Okay, if that's your question, then it's not your choice. Your choice was to get into a conventional loan or an FHA loan, depending on your qualifications. If you qualify for a conventional loan, then automatically, depending on the amount of down payment that you put in, automatically they give you PMI. If you qualify for an FHA loan, depending on your down payment, automatically they give you MIP. So PMI or MIP is not your choice, it's just the type of insurance they get, which is very similar, and there are two different terms to it. PMI for conventional loans, MIP for FHA. So depending on the loan you get, that's the insurance you're going to get with it. Okay? Cool. All right. And then we have Alondra asking a question. Okay. If you qualify for both of the loans, is it better to go for one over the other? Great question. If you qualify for both loans, if you qualify for either an FHA or conventional loan, which one is better? To address that question, I think we need to know where you are in life. Is it the first time that you're buying a house? Is it the second time buying a house? Third time buying a house? Whatever it might be. FHA traditionally is for first-time home buyers, traditionally. But can you get an FHA on a home later on, even though you're not a first-timer anymore? You might be able to. Now, the advantage of FHA is because it has really low down payments. We're going to talk about that better in one of these in this chapter still. So we're going to talk about better about FHA. But the advantage is the really low down payments to get into a property. And that chance might not be there later on. So your first time buying, you should exploit fully the advantages of FHA. Now, conventional loans at one point, and this keeps on changing, that's why having a good relationship with a loan officer is very important. At one point, conventional loans were being given with as low as 3% down payment. So you could get even better down payment than an FHA. And at one point, there was an incentive, a couple years ago, there was an incentive by the state and federal government where they would contribute up to 2% of your down payments. So technically, all you needed was 1% down payment and you were in. You understand? So it depends on where you are in your life and what your goals are. Should you go FHA? Should you go conventional? Right? Because don't forget, every time there's a government-sponsored program, there's also other fees that come with it. So you can take advantage of that loan. The thing is, those fees are going to be rolled into your loan. You might not feel it right away, right? But it's costing you more than if you went with a conventional. Then again, in a conventional, you might need more down payment depending on the programs they currently have available. So you see what I'm saying? So which one is better? It depends. At the time of purchase, let's sit down and look over it. That's what I would tell a client right away. Let's sit down with the mortgage, with the loan officer. Let's see how much it's going to cost you over the next 30 years. Mr. Buyer or Mrs. Buyer, is this going to be a short-term purchase or a long-term purchase? There's a lot of variables. There's no cookie cutter, this is the best. No. But FHAs traditionally, because they don't change much of what they are, FHAs traditionally are the better option to start with if you have low credit score or if you have not much money to put as a down payment. All right? But again, we'll talk about that better in a different part of this chapter. Real quick, release. What is the release? We already talked about this. Remember, the bank has a grip on your property. That means that if you finish paying off the loan, they must release that grip that they've had over the past 30 years. The grip was simply, if you don't pay, we are entitled to take your property away by foreclosure. If you finish paying it off, then you defeated the bank. It's called defeasance clause. You beat them. You got to zero. And they have to file or execute a satisfaction or release or mortgage discharge document that says, hey, we're no longer entitled to your property, right? If it's a title theory state where they use deed of trust, once you pay it off, they have to release the deed or issue a deed of reconveyance, transfer back to you. All right? Cool? Questions? Nina, Felix? Some people are in like 10 conversations at the same time instead of being here. I see all your screens. You think it's just a camera on you? No, it's recording everything you're doing. Anyway. Nina's asking what's a short and long-term purchase. It depends. A short-term purchase could be a 5-year. You're going to stay there for 5 years. The reason why I'm asking this is until recently, the average American moved every 5 years. So you buy a house, 5 years later, you're selling. Those numbers have increased a little bit to 7 years, more or less. So every 7 years, somebody moves. So that's why I'm asking, is this going to be a short term? Are you going to move in 7 years from now? Do you have plans of moving in the next 7 years? Let's say max 10 years. Or you plan on staying here for 30 years. So what's the difference between a short term and a long term? Long term, you're staying there for the long run. You know you're going to finish paying it off. You're going to reach balance zero, right? Or is it a short term, meaning you're going to sell before the end of the loan, right? Some people don't know, and some people have a pretty good idea of what they're doing. They're buying right now, but they really want in Jersey, but they really want to move to Florida. So I know that over the next maybe 10, 15 years, right, they have intentions of moving to a different state. This is for now. Now I'll advise in different types of loans based on what I just found out. Okay? Good? All right, guys, so let's go into that quick break. It's 12:22. We'll be back at 12:35, okay? So you get 12 minutes, 12:23 right now. You have a 12-minute break. We'll be right back. When we get back, guys, before you go, when we get back, make sure the camera is on you. Not facing your forehead or facing the ceiling or facing the floor, on you. I need to see what you're doing if you're paying attention to me, right? And those of you that are typing away, chatting with a bunch of other people at the same time, pay attention, please. Things are going to start to get complicated from now on, all right? So if it hasn't been complicated yet, they will be now. Just letting you know, all right? Thank you, guys. I'll be right back. Whoever's watching on YouTube, we're going to start a new session in about 10 minutes.